Hello everyone, and welcome to Financial Accounting. Today we're going to be covering Chapter 6, and Chapter 6 is basically a continuation to the previous chapter where we were talking about merchandising businesses. So one of the major assets in merchandising businesses is inventory. So this chapter focuses on inventory, and it talks about inventory in terms of how to protect it and why it's important to protect it. And then we'll talk also about something called the inventory cost flow or the cost flow methods related to inventory. So let's start talking about the control of inventory. So the two primary objectives of control over inventory. The first one is to safeguard the inventory from damage or theft. And again, it varies from one business to another. Some businesses, they work in small items that have large value. And some other businesses, they work in large inventory items that have very small value. So it depends on the business itself, but in both cases, or whatever the business nature is, inventory has to be protected from getting damaged or getting stolen. The other thing is that we need to also report the inventory in the financial statements in the correct value. And that's another challenge because we typically, or a business would typically buy inventory and sell it on a continuous basis. So buying in different prices and different costs might have an impact on how we present the inventory in the financial statements. And we'll talk more in details about that. So how to safeguard inventory, in other words, how to protect inventory. So controls for safeguarding inventory begins as soon as the inventory is ordered. And typically we have three types of reports or documents that we deal with that are related to inventory control. The first one is what we call the purchase order. And we'll talk about it in more details in the coming slide. But in simple terms, this is the document that the business would send to its vendors or suppliers, asking them to send them this specific quantity of that specific item. And based on this purchase order, the supplier or the vendor would send the items requested. And then another document is the receiving report. And this is the document that's prepared whenever we receive the items. And the whole idea about, or the whole purpose of this report is to have a specific list of the items received from the vendor with its description and with its quantities. And then finally, we have the vendor's invoice. And this is a document that's typically sent by the vendor or the supplier with the items delivered. So now let's talk a little bit more about the purchase order. So the purchase order, as it says here, it authorizes the purchase of the inventory from an approved vendor. And by the way, businesses, they don't just shop around for the lowest price and the best deal or the highest discount in order to get their items. Usually they create a list of approved vendors, and these approved vendors would be based on these kind of characteristics. They usually have the best product, they have the best delivery time, they have the best cost, and based on that, we keep our relationship with that kind of approved vendor. But they don't keep switching from one vendor to another, and that's part of the control, because we don't want to open the door for the purchasing departments, for example, to start having like side deals with different vendors. Then we have the receiving report that I just mentioned also. This establishes an initial record of the receipt of the inventory. So usually when the items get delivered to our warehouse, we prepare this kind of report, and we just keep track of what are the items that we received. Then we have the price, quantity, and description of the item on the purchase order and receiving report are compared to the vendor invoice before inventory is recorded in the accounting records. That's another control procedure that's very important, that we compare what we received to what we ordered to whatever is listed in the invoice that was sent by the vendor. And if there's a match, then we go ahead and record it in the accounting records. So recording inventory using a perpetual inventory system, which is the system that we're going to be focusing on for the sake of this class. Again, if you move up to intermediate accounting, we usually stress more on the periodic system. We want to see like the difference between perpetual inventory system and the periodic inventory system. But at least at this stage and for the purpose of this class, we're going to focus on the perpetual inventory system. And as I mentioned before, the perpetual inventory system nowadays, with the help of technology, is going to be one of the most commonly used inventory systems among many businesses. So it's also an effective means of control. So the amount of inventory is always available in the subsidiary inventory ledger. Controls for safeguarding inventory should include security measures to prevent damage and customer or employee theft. Some examples of security measures include storing inventory in areas that are restricted to only authorized employees, locking high-priced inventory in cabinets, and using two-way mirrors, cameras, and security tags, and sometimes just using guards to protect inventory. And I think some of these examples are very common to us. So we see, like in grocery stores, some of the high-priced items, they're usually locked in cabinets, like, for example, cigarettes, baby milk, alcohol. Sometimes, like, there's some unique items like razor blades and things like that, because these are small items with relatively high value. And again, like these grocery stores, sometimes they do some kind of research, and they found that these are one of the common products to be shoplifted. So also using two-way mirrors, this is very common in grocery stores and some other stores. They use cameras and security tags, like department stores, they do that. So again, these are different ways of safeguarding and protecting assets. Now let's talk about reporting inventory. So a physical inventory, or count of inventory, sometimes I like to call it the physical count of inventory, should be taken near year-end to make sure that the quantity of inventory reported in the financial statement is accurate. One of the worst things is that in real life we have something in the books that doesn't really match with what we have in the warehouse. So to make them the same, what businesses do is that they do this kind of physical count of inventory. And there's always some differences. And why? Because of all the reasons that we mentioned before. Shoplifting, or employee theft. And by the way, employee theft is something very common in businesses. And also like damages and things similar to that. So after the quantity of inventory in hand is determined, the cost of inventory is assigned for reporting in the financial statements. Most companies assign cost to inventory using one of three inventory cost flow assumptions. And we'll talk about that in a second. So we have three methods for cost flow assumptions. And one of these methods is what we call it FIFO, which stands for first in, first out. And this cost flow is in the order in which the costs were incurred. So first items we purchased are the first items to be sold. And you see here the box, it's like the new purchased items would go on the top, and then the goods sold or the sold goods would go from the bottom. Then we have the last in, first out. And the last in, first out, this is where the cost flow is in the reverse order in which the costs were incurred. So the last items that we purchased are the first items to sell. And in this case, it's like a box, and you get your inventory and you keep stacking them on top of each other. But at the time when you're selling it, you're just taking from the top. You don't really dig to the bottom. So this is what we mean by last in, first out. So we always assume that the items that we last purchased are the items that we first sold out or sell out. And then we have something called the weighted average cost. And the weighted average cost, this is like mixing things together. Okay, so cost flow is an average of the cost. And here we just keep purchasing things and we put them in the box, and we have just some kind of a side door where we just grab something randomly from the middle. Of course, this is just a simplified illustration. In real life, things doesn't go into this way, but in other words, we just do record the transactions in the books using one of these methods, but the real flow of the inventory might be different. So let's assume that we have three identical units of merchandise that are purchased during the month of May, but they didn't happen all together. And let's say I'm in the business of selling pens. And I bought 3 pens. So I bought the first one on May 10th, then the second one on May 18th, and then the third one on May 24th. As you can see, these are identical pens. There are no differences between them. But the only difference is that the cost incurred to acquire these pens were different. So the first one was acquired at $9, the second one at $13, and the third one at $14. The problem is we cannot identify which one is which because they're exactly the same. As you can see here, they look exactly the same. Some products, they have like some kind of identification, but in many items, it's hard to tell the difference. So in this case, we purchased 3 items in a total of $36. And the average cost per unit was $12 because if you add the 9 and the 13 and the 14, altogether 36 for 3 items, 36 divided by 3 is $12 each. So if we're using weighted average, then we're going to say, oh, the average cost is $12. So assume that one unit was sold on May 30th for $20. So the selling price was $20. Depending upon which unit was sold, the gross profit varies from $11 to $6. And the ending inventory value varies from 27 to 22. So let's try to explain that. So let's assume that we made a sale by the end of the month, which is May 30th. So we sold one of these pens, only one, and we still have 2 left in our inventory. So we sold only one for $20. The cost of goods sold was the item of the first transaction, the one that we purchased on May 10th. And then remember, that one cost us $9. So in this case, we had a gross profit of $11 because 20 minus 9, it's $11. And our ending inventory, though, the remaining 2 would be the $13 and the $14 pens that we purchased on the 18th and the 24th. So the total ending inventory in this case would be $27. Now let's assume that we sold the pen that we purchased on May 18th. Again, the selling price is the same, 20. But the cost of goods sold would be different. It's not going to be the 9, it's going to be 13. Because remember, we had this one purchased on the 18th at $13. So we'll assume that this is for $13. So the gross profit would be $7. And the ending inventory would be the original one, the first one, which is $9, and the last one, which is $14, for a total of $23. Let's see the third scenario. Let's assume that we sold the item or the pen that we purchased on May 24th. So the sales is still the same. The selling price is 20. The cost was the highest because remember the last one we purchased was a little bit more expensive. So the cost was 14. And then in this case, the gross profit is 6. And the ending inventory would be the first 2 pens that we purchased, which was 9 and 13 for a total of 22. So again, you can see here that the gross profit would vary depending on which item we sold. And of course, this is because the cost of goods sold is affected by which item we sold. And the same thing for the value of our inventory. So now let's summarize that. There's one more method that I just want to add, which is called the specific identification inventory cost flow method. And in this case, we can trace which item we sold based on a serial number or some kind of identification to the item that we sold. Is it very common? It's only common in businesses where we have maybe very few items that can be easily identified, and the sales transactions are not so many. So under the specific identification inventory cost flow method, the unit sold is identified with a specific purchase, and the end inventory is made up of the remaining units on hand. Because the specific identification inventory cost method requires each inventory unit to be separately identified, it's not practical for most businesses to use. So the other 3 methods that we just mentioned is FIFO, LIFO, and weighted average. Let's see how they work. So under the first in, first out inventory cost flow method, the first unit purchased are assumed to be sold, and then the ending inventory is made up of the most recent purchases. Under the last in, first out, or LIFO, inventory cost flow method, the last unit purchased are assumed to be sold, and then the ending inventory is made up of the first purchases. In the weighted average inventory cost flow method, which is the same as average inventory cost flow method, but we call it weighted average because it varies, depends on when we purchase the items, sometimes called the average cost flow method. The cost of the units sold and in ending inventory is a weighted average of the purchase cost. So the purchase costs are weighted by the quantities purchased at each cost, thus the term weighted average. So in the next video, I'm going to review this one more again, and then we'll see like more practical example that would explain these three methods again.